Hello, and welcome to Macro Minutes. During each episode, we'll be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Hello, everybody, and welcome to this latest edition of RBC's Macro Minutes podcast. Today is August the 13th, and I am joined by Su-Lin from our Australian team and Blake from our US team to discuss the current stance of central banks in our respective jurisdictions and how they are responding to the latest inflation challenges.
Thanks, Cathal. Let's start with the Bank of England. That was a very unusual rate cut recently, 2 rounds of voting and a pretty close decision with that 5-4 split. What are your thoughts here? Is the Bank of England done, given that hawkish cut?
Thanks, Su-Lin. I'd actually forgotten about the 2 rounds of voting and all the excitement around the bank last week. Yeah, it's an unusual procedure this time round where we had a 4-4-1 split on the first round of voting, and then the governor held a second with a constrained option to get a majority decision. So slightly unusual outcome, but certainly kind of the bank much more interesting than we thought going into the event. Not least that vote split. I mean, a much greater dissent against the rate cut than we thought was likely ahead of the meeting. And as much as kind of the number of committee members who were voting to hold rates, it's also kind of, sort of who they were. You now have 2 of the internal members, Hugh Hill and Claire Lombardelli, both dissenting to the hawkish side. Now, the significance of that is they are essentially the bank's internal analysis unit. So Claire Lombardelli is the Deputy Governor for Monetary Policy, and she is the one who compiles or oversees the publication of the bank's quarterly monetary policy report. Hugh Hill is obviously the Chief Economist. So together, they are essentially the bank's kind of the people who compile the bank's analysis, particularly that quarterly basis. So significant that they, the ones who will sort of put evidence before the committee, who will brief the committee, are the ones who are dissenting, in this case, voting instead to hold rates at 4.25%. The other thing kind of from that came out of the bank meeting, it kind of continues this pattern we've had since the bank commenced its cutting cycle last August of a hawkish cut, dovish hold, hawkish cut, dovish hold. So that was very simply the kind of the pattern we've been locked into over the last year or so. What was different this time round was the adjustment of the language. So previously we had the gradual guidance, which we all thought was basically implying the bank would go at this quarterly pace in those meetings where they have a forecast and they hold a press conference. But I think kind of the outcome of this meeting, to us anyway, appeared to show that the bank was much less on autopilot going forward. The rate cuts are much less automatic from here on. I think kind of the exact wording was that the time and pace of future reductions in the restrictiveness policy would depend on the extent to which underlying disinflationary pressures will continue to ease. So I think kind of this is a much different stance from the bank than it was previously. Like I said, previously I felt it was very automatic, that as long as the data was allowing it, they would continue to kind of go at this quarterly pace. Now going forward, much less certain as the path of policy going forward, and in particular, kind of whether that quarterly rate still applies. I think kind of the data from here on will have to support rate cuts rather than just kind of not standing in their way.
So the onus then is very much on the data going ahead to support further easing. And I'm assuming on that front in particular, at least some better signs in terms of inflation. The challenges there for the UK seem pretty significant. Why is inflation so sticky? Why is it trending upwards, kind of in the opposite direction to Australia and a number of other countries? Is that really what the Bank of England is waiting for and looking for progress on?
Yeah, so on the kind of the first part of your question, I think kind of the meeting adjusts the way we are kind of viewing the data going forward. I think you said kind of, implied that sort of the bank is more data dependent going forward. I think that's fair enough. I think up until now, we'd kind of viewed banks' communication, or indeed the sort of data releases through the prism of, will this cause the MPC to adjust their gradual guidance? Will this cause them to accelerate perhaps the rate of the pace at which they are easing policy? I think following this meeting, the view in the data is much more, will this allow them to continue to deliver more easing? And I think it's an important distinction as to how we view the data from here on. You mentioned sort of the inflation backdrop here in the UK, and I think it's, as you sort of implied, inflation's going in the wrong direction for the bank. So the last sort of print we had, CPI inflation was at 3.6%, and the bank expects it to peak at 4% in September. Now, a lot of that is administered prices, prices which are regulated by the government or sort of set by the regulatory bodies here in the UK. So stuff like public transport, fares, and domestic utility bills. But I think the new element which concerned the bank at last week's meeting was the direction of travel and food prices. A lot of concern about sort of food prices for inflation and how that feeds into inflation expectations, or the fear that may well feed into inflation expectations. In respect to domestic inflation, services inflation is broadly sort of drifting sort of sideways, should we say, as the bank expected. Slow progress still on squeezing that services inflation out of the system, which is something we chat about on previous editions of the Macro Minutes podcast. But what's really, really concerning the bank, I think what's really concerning the hawks on the bank, is wages, and what's happening to wages, of what's still happening with wage inflation in the UK. So we've had a drift up in unemployment. So the unemployment rate has gone from about 4.2% a year ago to 4.7% here in the latest releases. So there's been and you look across lots of metrics, and you can see the loosening in the labour market in the UK. Wage growth is coming down much more slowly. And I think what's concerning the MPC, and it was said in the press conference afterwards, was that wage growth is still above where most of the bank's modelling suggests it should be. So the bank's a bit puzzled why, we've got this loosening in the labour market. It's been in place for quite some time now. It was accelerated by the tax changes we saw in the budget. And yet wage growth still up at around 5% and ticking down very slowly. Now, to put that in perspective, the bank, at a recent conference back in May, the bank indicated that a range of somewhere between 3 and 3.5% in terms of wage growth was consistent with the inflation target. So we're still quite a way above that. And like I said, quite a way above where the bank's internal modelling thinks it is. So, the concern from the MPC is that there is something structural going on in the UK labour market that is keeping wage growth high, that is preventing it sort of responding to those easing conditions. So, that I think is that combination of still high domestic inflation and, wage growth, which is not playing ball in terms of what it should be doing in the bank's minds, is what's concerning it. And indeed, we had, if you read the minutes, even those voting for a rate cut last week were not desperately convinced, shall we say, that the disinflationary process was that ingrained in the UK. And I think it was Dave Ramsden, one of the deputy governors in the press conference, who said, that inflation was, one of those who voted for a rate cut, admitted that inflation was proving more persistent than he thought. And it was he who flagged the issue around wage growth being above the bank's models.
That's interesting. I think when we try and look at if there's any lessons from the UK and what's happening with the Bank of England to Australia, there are some similarities, but also some differences. So I guess unlike you, we had a fairly boring, we would say, RBA decision this week after some fireworks at the last meeting where there was an unchanged decision in July and a split vote, and a lot of us were caught off guard because we thought the case to cut in July was pretty strong given the progress in terms of inflation, and that's a little different to the UK. This week we had the cut that we and the markets expected, so 25 basis points, cash rate at 3.6%, a unanimous decision, so quite stark contrast to the Bank of England. And I think it stemmed from this confirmation from our recent Q2 inflation, that comprehensive inflation report, that underlying inflation was now comfortably back within the Reserve Bank's 2 to 3% target range at 2.7%. Importantly, the components that we're all watching and the bank is watching, services inflation, non-tradable, discretionary, all moving lower as well. The bank appears a lot more confident that inflation will remain sustainably within target, and that's allowed them to cut. So we would say the RBA has been a bit reactive, and I think it's understandable given the global uncertainty. There's been a lot of discussion in Australia around where is neutral, and the RBA seems quite uncertain on that front. With the cut yesterday to 3.6%, they've suggested it's now within a pretty wide band in terms of a neutral range, but there is still a lot of uncertainty over that. And I think maybe part of the reason they've been a bit reactive as well is that this is quite a new setup with an independent monetary policy board. It's only been in place for a few months. It has a number of new members. It is evolving, including for the first time publishing unattributed votes and some new communication. So the RBA is still going through a lot of changes. There's a lot of uncertainty still globally for them. Policy is now less restrictive at 360, but they do seem a bit reactive. And I guess to borrow a phrase from you, Cathal, that applies to the Bank of England that the RBA appears to have adopted is this sort of gradual approach to easing policy. We've had 3 cuts now at a quarterly pace after each forecasting round. We would expect that to continue. That seems to be very much the message coming from the RBA. And so we are anticipating another cut in November and then one more in early 2026 to take terminal to 3.1, which is roughly where we would put neutral.
I was going to ask, actually, Su-Lin, the adoption of the gradual guidance by the RBA. In the case of the Bank of England, I mean, it kind of reflected in essence, some of the uncertainties that came out from the budget last year, and then it became an all-encompassing thing. But also it was, just due to uncertainty around this inflationary process in the UK. The backdrop for the RBA sounds a bit better. Why are they sticking to that sort of gradual language? Is it just those external uncertainties you mentioned?
Yeah, I think it is the global uncertainties, although clearly less so compared to that April period and the extreme volatility. So the global uncertainties are still there. The transmission of tariffs and through to the real economy, in particular China and the US. So there is definitely some uncertainty there. But I think it also reflects, like I said, those other 2 factors. Not really sure where neutral is. So if you're not really sure, you go, I think, more carefully and you tread more cautiously and you wait for data to confirm that it's appropriate to ease policy. And then also, I think this new board. So there's a number of reasons why they're moving more cautiously and gradually. I think part of it also reflects the lower starting point for the cash rate, unlike a number of other countries, including the Bank of England that started their easing cycles last year with cash very restricted at 5% or higher. We started at 4.25. So by definition, we don't have as much room to move, and you want to be sure. I think as well, to your point around inflation challenges, particularly around the labour market, while the inflation picture looks much better in Australia, there are some longer term challenges because we too have quite low productivity. Unit labour costs remain fairly elevated in Australia. And so while inflation is back within target, how much lower it can push is going to be challenging in a world where productivity in Australia is negative, and unit labour costs are elevated. And probably the most interesting thing that came out of the RBA this week was the downward revisions to their assumptions around productivity medium term. That makes for some pretty somber reading, because ultimately that's what you need to really lift real wages and long run growth and living standards. So those challenges are there as well, and I think that's also feeding into their caution.
That sounds eerily familiar to what we have here in the UK. In that, productivity growth is also in negative territory for the last couple of years. And indeed, I think kind of one thing from the Bank of England's perspective that struck us over the last year or so is how unresponsive to the growth backdrop it is. We have essentially kind of, sort of flat to mildly positive underlying growth here in the UK, combined with a tight labour market, low productivity growth, and hence this domestic inflation picture that you see. You're due another labour market report this week. Do you think that will kind of impact on the outlook for the RBA significantly?
I think the labour market comes into focus a bit more now in terms of the RBA and policy deliberations. Now that inflation is within the target range, there is a bit more focus on the labour market. We did get quite a weak print last month in June. The unemployment rate unexpectedly jumped up to 4.3%. That's the highest rate since for a few years, since late 21. And so there has been some discussion about, is the labour market weakening a bit more? We know that it has loosened a little bit over the last 6 months, but it still remains extremely healthy. There's ongoing employment generation, participation still elevated, not far from historic levels. Hours worked continue to rise, and an unemployment rate at 4.3% is still very low by historic standards, and arguably pretty close to full employment. So the labour market looks pretty good, not as tight as it was, but it is interesting. The RBA's forecasts are for the unemployment rate to flatline at 4.3% really all the way through to 2027. I guess there is some concern that maybe the labour market will soften up a little bit. Private demand here has been quite weak over the last 12 months. And so we think that the labour market and the suite of data probably is more important for policy deliberations going forward for the RBA. What could get them to move away from gradual or to cut by more than we anticipate is a much weaker labour market. But we are mindful that it will probably take a few months to evolve and play out if that's the case. And so, yes, I think there may be a bit more focus on the labour market going forward.
Su-Lin, thank you very much for that. Changing continents, we're joined by our US rate strategist, Blake Gwinn, as well today. Blake, a picture of loosening labour markets coupled with still challenging domestic inflation picture, is that one that resonates with you? We found the market reaction to this week's CPI print a little bit curious, so maybe something you'd like to unpick in that.
Yeah, I completely agree with you, Cathal. I think what we have in the data right now is this kind of very stagflation light type of environment where we are seeing continued softening in the labor market. Now, I'd be very careful to characterize that as further softening rather than, a more serious deterioration or, the start of some kind of self-accelerating process. Where unemployment starts to rise, like we were worried about with the SOM rule trigger last year, or kind of a more typical recessionary pattern. But it's hard to deny that, yes, the labor market is softening. And at the same time, inflation is a bit problematic. Powell said himself that even if you strip out the impacts, potential impacts or realized impacts of tariffs, that inflation is still likely in an uncomfortable place for the Fed. So I think that's definitely describes the situation on the ground pretty well. Now, the problem with that is that, to me, that is not a clear home run to start the cutting process. But yes, to the second part of your question, I did find the market reaction to CPI a bit curious. We got what I think it was a fairly benign print, but if you really go through some of the details, if anything, there were some reasons for the Fed, I think, to be a bit concerned. You do seem to have some signs of reacceleration. The 0.232 month over month print for core, second largest month over month this year. If you kind of look at things on a 3-month annualized basis to kind of get a sense of the momentum or kind of the near term trend, that's at 2.8% and kind of rising. You've got the 12-month core CPI at 3.1%. So that's showing some signs of acceleration, even when you get down into the breakdowns. We were expecting, and I think a lot of people were probably expecting goods to really be leading the way higher, just given some of the tariff pressures. But this print actually showed services ticking higher, and services were supposed to be kind of the savior, meaning, offsetting some of the tariff-related inflation pressure. So you take all that on board, you look at these things like the super core that, the Fed used to focus on last year, which is looking problematic. It wasn't a great print. So I am also, I totally agree with the premise of your question that I was a bit surprised at how markets seem to have taken this as kind of an open door, not just to cut 25 basis points, but you now have these conversations around a 50 basis point cut and pricing for that in the market starting to pick up.
Great, that's great, thank you. So where do we go from here in terms of the Fed? After the NFP print, you said that you still lean towards the Fed delivering a first rate cut in December, but our confidence in the September hold is certainly lower now. Still standing by that?
Yeah, again, I have to agree with you here, Cathal. We're still leaning for a first cut in December. That is still officially our call. But my confidence in that over the last 2 weeks, basically, back to before this last NFP print, has certainly fallen. But I guess what I would say is that part of the reason that confidence has fallen is less really the fundamental story about what the data is doing and really more about the narrative itself. I think having those two dissents, having all of this constant pressure coming on the political front, plus now the fact that the market's really kind of pushing the issue, we're more than fully priced for a 25 basis point cut in September. If anything, that's making me a little bit more worried about that September cut than the actual data. So, I still lean to the side of a pause in September, but it's a much, much closer call, given all of that narrative stuff that I just mentioned. On the fundamental side, yes, there was a lot of headline shock around the NFP print, particularly around those very large revisions. But as we wrote in a piece that came out after that NFP print, you look at a lot of those revisions, and to me, they're not really showing something that's particularly cyclical. I think there's a lot of instances that you can point to that are very specific, I would argue idiosyncratic kind of exogenous type shocks coming from administrative policy or other government policies that, again, aren't really a sign that the cycle is necessarily turning. So if I'm the Fed and I'm looking at, roughly half of those downward revisions coming, almost half of those revisions coming from state and local education, which is probably more a function of funding, COVID-era funding to hire teachers running out, nothing to do with the state of the business cycle. Or if you look at some of these things, these categories that are probably related to, the real spike in uncertainty around trade that we had in May and June following Liberation Day, that's not particularly cyclical. So if I'm looking at a lot of those downward revisions and even the low NFP print itself, we just don't know with the state of this labor market what the true, if you want to call it a break-even NFP print, we don't know how many jobs really that the economy needs to create to kind of sustain the economy at this point, just given a lot of the shifts that we're seeing because of immigration policies, because of retirements. These things are impacting kind of the nature of the labor force, and we don't know what that means in terms of NFP prints. That's why I think you have Powell, very clearly saying, I think the unemployment rate is the most important metric to look at because it does incorporate some of those shifts in the makeup of the labor market. So, I look at all that stuff, the fact that those revisions don't necessarily look cyclical, the fact that the unemployment rate, despite almost rounding up to 4.3, is still at 4.2, a very comfortable level historically. The fact that you don't see permanent layoffs, starting to rise. I just don't know that the argument, the fundamental argument for a cut on the labor side, I just don't know that it's particularly pressing. And then you layer in all the inflation risks, we kind of talked about in that last question. You layer in some of these tariff risks, the fact that, we might see that bleeding in over the next 3-6 months, continuing to push up the goods side, but also some of that probably filtering over into the services side. And the fact that we're still at a 3 handle and seem to be picking up some upward momentum and on the inflation side of the mandate, I think it's very hard for the Fed to really get serious about insurance cuts here. So yeah, we're still holding with December for the first cut. I'm a lot less certain about that, to be totally honest with you. It's much harder to see that, but like I said up at the beginning, a lot of that uncertainty comes more from the shift in the narrative and the fact that the Fed has seemed to not really want to disappoint markets over the last 3 to 4 years than a particularly urgent warning sign coming from the labor market.
Blake, many thanks for that. Plenty in play for the autumn then, from your perspective. And with that, we bring this edition to Macro Minutes to a close. We hope that you enjoyed this edition as much as we enjoyed hosting it, and hope that you will join us again in the future for further discussions of markets and policy.
Thank you, everyone, for joining this episode. If you have further questions, you can reach out to us directly or via your sales coverage, or visit RBC Insight to read our content.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.